Chapter 6 focus on managing your money, a very important topic. We'll take a look at a background on money management, look at the different type of money market investments, the risks associated with any type of money market investment, explain how to manage the risk of your money market investments, and explain how money management fits within your financial plan. So it's all about managing your money. Money management refers to a series of decisions made over a short-term period regarding your cash inflows and your outflows. So I want you to focus on your, let's say for 1 month, think about your monthly inflows, cash coming in. Now, let's say cash coming in, think about the net amount you receive, say from your paycheck or from any other income sources. And then think about your cash outflows. So it's good to write them down. Write down all of your cash inflows. Write down all of your cash outflows. Liquidity focuses on your ability to cover any cash deficiencies that you may have experienced. So when you list all of your cash outflows compared to your cash inflows, which is greater? If your cash outflows are greater than the cash inflows, that means you're going to have a deficiency. And the question is, how are you going to cover those deficiencies? Do you have any savings or other income sources to assist you with making sure that all of your cash outflow needs can be met? So your personal cash flow statement will show all your cash inflows, all of your cash outflows, whether we call a surplus or a deficiency, and what source do you have to cover any of those deficiencies. Now, some may say, I'm going to use my credit card for liquidity. I can get a cash advance off of my credit card or use a credit card to maybe pay some of my cash outflows. Well, credit card may be an option, not one that I really recommend, especially when it comes to cash advances, because credit cards will typically have an extremely high interest rate. Interest rate could be in the 20%. Okay? So maintaining adequate liquid assets allow you to avoid using your credit card and pay high finance charges. So don't think of your credit card as a solution to take care of any of your shortfalls. Now, when you have short-term investments, you want to try to yield the highest return possible on your short-term investment. But remember that depending upon the option chosen, there's going to be risk with those different options. Typically, the higher the return, the higher the risk. So we'll talk about different type of accounts, like a checking account. Won't spend too much time here. Checking account, of course, is very liquid. A lot of banks provide what they call overdraft protection. So if you write a check, you don't have sufficient funds to cover it, the bank will actually cover it for you. And then, of course, your account may go negative, and you just have to bring that balance up. You keep the check from actually not clearing, so the person that you're paying can receive their funds. And then, of course, you may have to pay a fee to the bank because your account didn't have sufficient funds. Okay? Now, typically, if you have a situation taking place too often, there are some fees that may be charged by the bank for your account being overdrawn. Stop payment simply means when a person writes a check and for some reason they decide to stop payment on it. Maybe they wrote a check to someone for a product and the product didn't come or the product didn't meet the requirements and they decide to do a stop payment on it. So that's a request that you're sent to the bank saying, please do not honor this check if somebody tries to cash it. So typically this takes place when you wrote a check, but for some reason the person you wrote the check to is not worthy of that check because of what the circumstances are, and you want to have the bank to not allow a check to go through. Direct deposits, you know about that. Fees vary from institution to institution. So depending upon who you're banking with, some charge, there's the scope of fees that they charge for overdraft protection, for bounce checks, things of that nature. Some checking account um, charge you a monthly service charge, some do not. So make sure you study and understand the different fees that's being charged by an institution before you decide to bank with that institution. Now, most checking accounts do not pay you interest. So the money in your checking account typically does not earn interest. Some do. So again, you want to also know whether or not, if you have a checking account with an institution, if you can earn interest on your money. Now, NOW stands for Negotiable Order of Withdrawal Account. A NOW account is a type of account that provides checking services and also pays you interest. So you can have a NOW account by a depository institution such as your bank. But with the NOW account, what it does require is a minimum balance. So the NOW account may say that you're required to keep $5,000 in that account. Now that bank does pay you a higher interest rate, but because you're required to keep a certain amount in there, it's not as liquid as a regular checking account. But if you know you have an amount of funds that you don't have a need for at the current moment, you may decide to get like a NOW account because you're going to get a better return off of your investment, but also understand that the funds in that account are not as liquid. Savings deposits typically pay interest, slightly less liquid than checking accounts. So sometimes you have money in your savings account, depending on who you bank with, it may take a day or two to get those funds from the savings account because often there's no check, so you got to transfer the funds or something of that nature. But with a savings account, typically they pay a higher interest rate than a checking account, but they're not as liquid. Some people, individuals, which is a smart idea, when you get paid every week or every 2 weeks, they may have a certain amount from their paycheck going to a savings account automatically in order to accumulate more in their savings account. Okay? Certificate of deposit, known as a CD, is a way to get a higher return on your investment. CDs typically come in small denominations, 500, 1,000, 1,500, etc. But they typically pay a higher interest rate than you get from a savings account. However, there are penalties for early withdrawal. So if you have an 18-month CD, you cannot take the funds out of that CD before the 18-month period. If you do take those funds out before the time period of the 18-month, then they will charge you a penalty for early withdrawal. But CDs are a pretty safe way of investing your money to get a higher return. Just make sure you understand the terms associated with the purchase of a CD. Okay? Next, we have an MMDA account, which stands for a money market deposit account. So again, it's another account that's offered by your depository institution. It does require a minimum balance, and it does pay interest. However, it will limit the number of checks. Excuse me, the sneeze. It may limit the number of checks you can write within each month. So with the MMDA account, which is basically an account that you have more for savings purposes, but you may need to draw funds from that account on occasion. Again, typically it requires you to keep a certain amount in the account. It does pay you interest, but you may only be able to write maybe 5 checks a month. So if you say, well, for this account here, I don't need to have to write that many checks out of this account. I like the idea that it's paying me interest, a higher interest rate. So this might be an idea. See if your institution offers an MMDA account, which stands for a money market depository account. Okay, so many people will keep a checking account or a NOW account for their day-to-day operations, and a money market account as more of an investment, because again, the money market account typically pays a higher interest rate, but there are limitations on being able to withdraw funds out of the money market account, and you're required to keep a minimum balance. Okay. Other type of investment dealing with the government are treasury bills, or what we call treasury securities. These are debt securities issued by the U.S. Treasury. Typically, they're very liquid. These are going to mature in a time period of 1 year or less. The good thing about the Treasury bills is that often there are some tax implications, meaning that if you have these Treasury bills, sometimes the gain or the interest earned is not going to be taxable. So people like to acquire Treasury bills because it is a type of investment, and also sometimes the interest earned on Treasury bills may not be taxable from a federal income tax standpoint. It may be taxed on the state income tax. Typically, we're going to buy them we call the secondary market on the stock exchange markets, where typically you can purchase these different type of treasury bills. Okay. Other type of investments, a money market fund account. This account that pools money from individuals and invest in securities that have a short-term maturity. So when you have a money market fund account, it means that the fund manager is taking your money, someone else's money, another person's money, they kind of put it all together. And in a sense, they're taking those funds and they're buying securities that have a short-term maturity. It could be bonds, it could be equity security, but typically it could be treasury bills. But these securities typically are going to mature in less than 90 days. So these will be called very short-term liquid type of investments. Commercial paper. What's commercial paper? Commercial paper is typically a type of investment between two different companies, two different corporations. So typically with a commercial paper is when one corporation loans money to another corporation. That's why this is short-term debt securities issued by large corporations that offer a slightly higher return than treasury bills. So normally when it comes to commercial paper, this is an investment where one large corporation will loan funds to another corporation, and they will have them sign what we call a promissory note. This is known as commercial paper. Now, if you want to find out like what is the going interest rate on money market funds, you can look at any type of financial newspaper online, and you can see the current interest rate being offered by these money market funds. Okay, so for example, here's a money market fund. Average maturity is 43 years. It has a current yield of 3.28%, and it has a total asset of $496 million. So again, with these money market funds, it means that the fund manager have taken funds from all their different clients, merged those funds together, used those funds to purchase different types of securities, and this is the total value of that portfolio that's shared among those different clients. Okay, so if you want to know more about interest rate information, historical interest rate information, you can go to the federalreserve.gov website, and they'll provide you with a plethora of information about historical interest rate. You can see the trend, the current interest rate, what they call the prime interest rate. So I would encourage you to just go out there and take a look to learn more about the different type of interest rates from a historical standpoint on the Federal Reserve website. Okay, that's going to conclude part 1 of our Chapter 6 video lecture. Stay tuned for part 2.